One
Go
of your
ahead.
viewers said, "Where does Clive get his $15,000 gold prediction from? Or why 15,000?" I was talking, that was in the context of will the Fed revalue gold at a higher level in order to book a profit? Whatever level they book it at, higher than the $42.22, they'll make a profit.
I have some Newmont, and I think it looks really bullish. I think 100 is a realistic target as is. So I personally would say that if they revalued it to 15,000 overnight, yeah, it would be quite dramatic for not just Newmont, but all the other miners.
Clive Thompson, a retired wealth manager, has made a striking prediction that gold could reach $15,000 per ounce. His forecast isn't based solely on speculation, but rather reflects his analysis of potential Treasury revaluation scenarios that could help address mounting fiscal challenges. Recent market behavior appears to support gold's appeal as investors have increasingly turned to the precious metal amid deteriorating economic signals. Thompson's bullish outlook stems from recent investor behavior, with many rushing to gold amid poor economic signals. He maintains there's no such thing as being too bullish on gold as fiat currencies lose value, stating that money is going to zero while gold's value could trend toward infinity. Industry experts at the Gold Bullion Company share this optimistic outlook, expecting gold prices to remain elevated throughout 2025. While they anticipate some volatility and minor corrections, the fundamental investment thesis for gold remains intact, as investors continue to view it as a crucial portfolio anchor during uncertain times. The broader economic environment supports these projections. With economic contraction anticipated in 2025 and the full effects of recent tariff policies still unfolding, some economists are preparing for potential recession conditions, historically favorable circumstances for gold prices. The gold case also rests on trends in currency purchasing power. While central banks work to manage inflation, historical patterns indicate a consistent erosion in the value of fiat currencies. The dollar's journey since 1970 illustrates this phenomenon. What costs $1 then requires over $7 today, demonstrating the cumulative impact of inflation. This trend has accelerated since the United States abandoned the gold standard, with the dollar losing more than 90% of its purchasing power over subsequent decades. Thompson's concerns about fiat currency devaluation reflect this broader pattern, positioning gold as an increasingly important hedge against monetary uncertainty. This video explores the outlook for gold and silver, highlighting the factors that could drive gold prices higher. If you appreciate data-driven insights, please like and subscribe for weekly updates. Your support helps keep our analysis going.
I don't think you can be too bullish if you're in it for the long term. But if you're a short-term trader, it's perfectly in order to jump around from short to long and long to short all the time and try and second-guess the market. And perhaps if we go back a few days ago before the latest jobs report last week, it did look like silver and gold were coming under a lot of pressure, as were equities. Well, the equities were doing all right, but then suddenly everything flipped. We had the jobs report, and gold and silver jumped up, and equities went down. So all those people who were thinking that gold's going to go down last week were selling it with the hope of buying it back later at a lower price, kind of got messed up by the surprise, the really awful number from the jobs report. So people sort of
Yeah.
rushed to the safety, didn't they? They rushed to the safety of gold. But I think long run, I don't think there is such a word as too bullish, because money is going to zero. So
Yeah.
where does that leave gold at the end of the day? It leaves it at infinity at some future date. We don't know when that will come. I saw one which was a bit earlier addressed to me,
Yeah.
Mario.
Yeah. Go
One of your
ahead.
viewers said, "Where does Clive get his $15,000 gold prediction from?" Or why 15,000? I was talking, that was in the context of will the Fed revalue gold at a higher level in order to book a profit? Um, Whatever level they book it at, higher than the $42.22, they'll make a profit.
Yeah.
The reason I got to 15,000 would be is it's enough to pay off this year's deficit and next year's deficit and reduce the national debt a little bit. It won't reduce it that much. But of course, there's plenty of people who think, well, they should do it at a much higher level to pay off the whole of the national debt. I think that's too risky. But I think there's no problem if they do change the price of gold. The question which everyone will have is if they change the statutory price of gold from $42.22 to today's price or some other level, will that put a floor under the gold market at the new level? Well, we don't know that. But obviously, a lot of gold bugs, myself included, wouldn't object if the price of gold is underpinned by a new statutory price from the Fed, or not from the Fed, from the Treasury. Disclosure, Mario, I happen to be an owner of some shares in Newmont Mining, so I'd be very happy if it went up to any figure above where it is now. I'm showing a little bit of a, let's say, a little profit at the moment, but yes, of course, if the gold price gets revalued, and this is the important point, underpinned by a bid from the Treasury, because that's really important, that it's got to have the bid as well. Nobody's going to sell the gold for less than the bid anywhere on the
No.
planet, and that means the gold mining shares would do very well. One of the things I've learned in my 50 years of investing is to heed warnings. And I suppose most of my career I didn't heed them. But the one which resonated most in my mind was prior to the 2008 global financial crisis. I was reading in reputable newspapers like the Wall Street Journal and the Economist about the impending housing price crash. They were giving specific examples of these loans which were being made to people who had no chance of ever repaying them. And they said it's going to be a big problem. This is long before it actually was a problem. And you know what? I read it, shrugged my shoulders, and carried on investing.
Yeah.
But now I think if I hear a warning, I pay much closer attention to it, and I think the world is getting a warning about the fiat system, the rising level of distrust in our central banks, and the ability to manage the nation's money supply and manage the nation's debt. That's obviously not the central bank's role to manage the debt, but it does seem that governments have lost control of the financial system. They're basically on a borrow, 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 and there's no end to it. I don't think I've ever had confidence in the labor statistics. They revise these numbers almost every month. They revise the previous months down, and the fact they revised the earlier months down by 258,000 jobs, and then said we've got an increase of 73,000. Well, that's an increase of 73,000 on a number which they reduced, a previous month number they reduced by 258,000. So actually, the reality here is we've lost 212,000 jobs. We lost, they've 200,000 jobs. Now I've done the maths wrong. 180,000 jobs, something like that. Those, if because the effect of revising down the previous month's number makes the current number look that much better. So they're very lucky that they got 73,000 when they should have been reporting a loss of, 180, 190,000. But to keep pace with immigration, they need a positive number every month of about 100,000. And
Well,
that's not happening. The other figure, which was pretty awful, was the household survey. That came in. I'm just looking here if I've got the figure, but it came in with a pretty awful number. The household survey is another jobs survey. It says the household. I just read this. The household survey, which forms the basis for unemployment rate calculations, showed an even more concerning decline of 260,000 workers, while labour force participation rate dropped to 62%, its lowest level since November 22, 3 years ago.
yeah.
Perhaps more alarming, the average duration of unemployment jumped to 24.1 weeks, the highest since the COVID pandemic in April 22, as it was ending, suggesting that the job market weakness is becoming entrenched rather than transitory. Well, we're seeing that rates remain elevated for 10-year bonds, for example, or 30-year bonds, they're rising. So despite multiple cuts all around the world in interest rates, the longer term bonds are not reacting because people are saying these cuts aren't really reflecting the reality of things. What we're in is a world in which the amount of government debt continues to rise, and a world in which the amount of money in circulation continues to rise. And therefore, if I'm buying a 10-year bond, I don't want to get a 2% yield. I want to have a 4% yield or a 3% yield. I want a higher level of yield to compensate me for the fact that you guys are printing like there's no tomorrow and borrowing money you can't repay. If a small amount of money leaves the stock market which probably represents 60, 70% of people's portfolios globally, and moves into gold, which probably represents 1% if we're lucky globally, it could really spike the gold price. And of course, silver is only, the above ground supply of silver is only 1/10 of that of gold, and platinum is only 1/10 of silver. So any money moving into the precious metal sector could spark them all big time.
Mario Inacco, a UK-based analyst, argues that current conditions extend beyond a typical precious metals bull market. He believes the fiat currency system faces severe strain, making gold and silver essential safe havens rather than merely profitable assets, echoing concerns raised by wealth manager Clive Thompson. The data supports these currency debasement warnings. Historical data reinforces these concerns. Since 1971, when the dollar's gold link ended, gold's purchasing power increased over 13,000% compared to a 2,600% rise in food costs. This performance gap demonstrates gold's ability to preserve value while fiat currencies consistently depreciate. Inacco sees precious metals as crucial during an approaching currency reset. With central banks struggling with unsustainable debt and monetary expansion, gold and silver could provide stability between failing and emerging monetary systems. The analyst warns that those without precious metals exposure may experience the full impact of currency devaluation, potentially losing most of their purchasing power. This highlights the importance of education and community support to help others understand these risks. Particularly concerning Inacco is the dollar's recent temporary strength, which he interprets as a warning sign rather than stability. He views this apparent strength as masking underlying weaknesses that could make an eventual monetary collapse more severe, emphasizing the urgency of establishing precious metals positions before broader market recognition of these systemic risks. Let's get back to the video.
I wanted to look at another article which tells me that people are losing faith in bonds. This is Japanese Farmers Bank vows caution after 12 billion loss from Treasury's bet. So that's the Norinchukin Bank. New chief says cooperative known for voracious buying of U.S. debt had taken positions that were too risky. So I think it's not only treasuries, but also JGBs. I think people are going to be a lot more cautious. I would say, Clive, in, maybe 2 years, but definitely in 5 years' time, this 60-40 rule that you have to hold 60% of assets if you manage money in stocks and 40% in bonds, that's going to be out the window. And I think gold, silver, and what they call alternative assets are going to be a lot more important. Chris Conman, thank you for your super chat. If gold is revalued to 15,000, will Newmont stock shoot up to 300 overnight? Thanks. I think it would. It would shoot up quite high. Right now, it's trading around 63, 64, and I think last year it bottomed around 30. And I have some Newmont, and I think it looks really bullish. I think 100 is a realistic target as is. So I personally would say that if they revalued it to 15,000 overnight, it would be quite dramatic for not just Newmont, but all the other miners. CAD 1050, what's your thoughts on UK Royal Mint DigiGold and DigiSilver? They say it's fully backed by gold and silver in their vaults. I've seen those DigiGold and silver from the Royal Mint. I don't trust them as far as I could throw the Royal Mint. Yes, the coins they mint, the gold and silver coins, are legitimate, but I wouldn't deal with them. I wouldn't send them any money for them to store Digi or DigiGold or silver to me. I think one of the reasons they do it is because the government, the Treasury, and the Bank of England have told them, try to keep people from buying real gold and silver. Start this DigiGold, DigiSilver. Yeah, I would. That's not the way to buy gold and silver. Normally, you can have a bull market in precious metals as we had in the early 2000s and so on. But now I think it's more than a bull market. It's the fiat currency system really on the ropes, and that's that's more than a bull market, in my opinion, Clive, for gold and silver. It's the place where you want to be, really, because it's like you see a tsunami coming. That I think it was 2004 that Banda Aceh tsunami, and you got to run, and this tsunami is coming, and you can't stay by the beach waiting for it. And do you remember that? I think what happened before the waves came back then, that it looked like the tide went out, like the water just was sucked off, and people stayed there. But it's something really unusual. But that was because of the tsunami. You could see the dollar rise quite sharply when things get really bad. But that would be the analogy would be the tide going out or the sea going out before the tsunami. I've always believed that central banks, they're not really, you can't profess to have free markets and have central banks because it's basically a monopoly and it controls the price of money and credit. I think it should be done through the market, through the free market. Yeah, the Fed is always like makes mistakes. This is not the first time, but I wanted to bring up a couple of charts here, Clive. The first one is gold to S&P ratio. So it's not S&P to gold ratio. It's the other way around. And I look at it, I mean, I'm only going back to 2011. It was a lot higher in 2000. It went a lot higher in 2000. So it means that, lower in 2000. But in 2011, it peaked here because when gold went to like 1900, and I think we've got a lot of room. We've had a bit of a consolidation here where the stock market outperformed, but it seems to be breaking a falling wedge, which in my book is quite bullish. We could go a lot higher than the high in 2011, which is about, just over 3 times where we are now in relationship to the S&P. So, and I think the downside here, Clive, is quite fairly limited. I'd say this 0.4 area is like is a huge support. It held here and it held back here as well. And I've got the Dow gold ratio. That's the other way around. That's in terms of the Dow, and we had the same consolidation up for the Dow gold ratio. And on Friday, Clive, it broke below that. So I think we could have a really interesting, let's say, final, 4 months of the year. Hi, Mario. When you lived in Brazil and hyperinflation kicked in, how was metals used for transactions? Daniel El Sovrano says, well, there was no one used gold and silver in Brazil. They used the dollar because back in the 80s, the dollar was still like, and even today, Brazilians use the dollar, I would say. So if you had dollars, you were fine. But if you didn't, I never no one ever talked about gold and silver in Brazil when there was the hyperinflation. It's weird. I really only learned about gold and silver as money, back in the late 90s, early 2000s when I was already in the UK.
The growing instability in fiat currencies, mounting pressure on traditional bond markets, and rising caution among global institutions point to a shifting financial landscape. In this evolving environment, gold and silver are no longer seen merely as speculative investments, but as essential stores of value and protection against systemic risk. As central banks, institutional investors, and individuals alike increasingly pivot toward tangible assets, the role of precious metals is being redefined, not just as defensive hedges, but as foundational pillars in a financial system facing structural uncertainty. Gold and silver are emerging as critical anchors of stability in a world where traditional models are being questioned and replaced. Both Thompson and Inacco represent a growing consensus among financial professionals that precious metals serve as essential protection rather than speculative investments during an era of unprecedented fiscal and monetary challenges. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for your support, and I hope you enjoy the video.